I'm delighted to go over the investment approach that we take at Delisle. And it starts first and foremost grounded in an approach to planning that we feel is very unique in the industry. Planning for us is much more than the technical discipline of planning. It's about understanding family dynamics and relationships in a way that will feel different in our firm. I'm very fortunate to have two wonderful partners at Delisle. Sandra Henderson. Sandra has many years of experience working with the wealthiest families in Canada and the US, and brings just an incredible breadth of skills as our Chief Compliance Officer, working closely with me on portfolio construction. My wife, Jean Blacklock, is formerly an estate lawyer and a psychotherapist presently, and really runs everything to do with our planning practices at the firm, working with clients to really understand purpose, priorities for the family, what they're trying to achieve, and perhaps most importantly, working with us to define ultimately what the priorities are that are unique to the family, not a generic approach to portfolio construction. Where I come into the picture is 30 years of portfolio management experience. I've been a portfolio manager since the late 90s. I've been a CFA charter holder since 2003, and pretty well my entire adult life I've been a student of the markets. And we really have taken an approach to our investment portfolio construction that I'm very proud of. It starts with a core belief around how markets work. And this is very important to stand back and understand what it means by efficient markets. Every single day, there's almost $1 trillion of equity exchanges going on across global markets. What that means is there's a lot of information that's being embedded every day as people are buying and selling securities. It also means that over time, you're not going to outsmart the markets. And I have a lot of empirical proof that can showcase this. For example, there's a study that happens every year. And last year, as of December 31st, 2023, 93% of active managers underperformed their index in Canada. You probably wonder how that can be, and it largely is anchored in another core belief of ours. Fees matter. What you pay in fees has a massive impact on your long-term performance. And so while that's not fancy, it actually is probably the greatest truth of investing. The lower the fee, the greater the probability that you're going to outperform the market over time. So let me illustrate why fees have such a significant impact on the overall portfolio returns over time. This is a study that was done in the US, and what they've done is stratify the cost of funds across 4 categories, from the lowest to the most expensive funds. You probably would be thinking the more expensive products are going to outperform over time because people are prepared to pay more for them. And in fact, it's precisely the opposite. Just have a look over here. The lowest expense MER products have outperformed the market 34% of the time. Still not super high, but compare that to the more expensive products over a 10-year period. Only 13% of the time do the highest quadrant expense products outperform the market, compared to 34% for the lowest cost. Fees matter in terms of generating consistent outperformance. And it's something that we definitely embrace within Delisle. Having said that though, passive ETFs are only one step there. They're not the entire way there. We still believe passionately that active management can contribute to outperformance over time, and I'll show you why. Active management is not stock picking. Guessing the markets in terms of whether or not I want to hold one bank over another, these are areas that have been proven are not going to generate significant outperformance over time. So let's talk about passive ETFs first. This is only the start, because when I say to you the market is efficient and you're not going to outperform the market over time, the passive ETF is not the market. This is often a big misnomer. Let's look, for example, at the S&P 500. There's many who would say, well, the S&P 500 is a perfect proxy for a market return, but you have to look at the composition of what is the S&P 500. And you've got 2 challenges. The first challenge is it is the largest companies in the market. So if you look at the S&P 500, these are the largest US equity companies that are listed. That does not necessarily mean they are the market, because in fact, The companies that are the largest often underperform in the following 10-year period because of the success they've had leading up to that composition. Another issue, for example, with the S&P 500, it is 500 companies. You're actually a third of your investment invested in 7 companies right now, 7 technology stocks. So you're heavily concentrated in one sector, and that again is not a proxy for the entire market. So while passive ETFs are a start, and we certainly do use passive ETFs to keep our costs low, it's not the whole answer. The whole answer is replicating the market in a disciplined and systematic way, but not exclusively tied to ETFs. And that takes us to our approach. Sandra and I, as we've been looking across the universe of options, of course are drawn to ETFs. Because they are low cost, they will provide diversification. It starts with asset allocation. How we structure the portfolio across geographies. Bear in mind, Canada is only 3% of the global equity markets. Our friends to the south represents well over 60% of the global equity markets, and you still have a third of the world to invest in. Broad diversification geographically matters a great deal, and we use building blocks that comprise equities throughout the world. That's step number 1. Step number 2 is how you manage the asset allocation, how you shift based on market dynamics. There's many studies that demonstrate that you can generate significant long-term value by virtue of how you manage the overall asset mix. We do believe in making shifts in the asset mix based on our market view, and we do manage asset mix quite actively at Delisle. Let's talk about how to replicate the market as opposed to replicating passive indexes. For equities, there's really 3 areas that we are very focused on at Delisle. First of all, over time, small and medium-sized companies have outperformed large cap companies. This is proven. We've gone back and back-tested this to the early 70s till today. Consistently, and I can demonstrate on a chart in a moment, small and mid-sized companies have outperformed large cap. Number 2, value companies, companies that are priced reasonably, have outperformed growth companies over time quite consistently. Our belief number 3 relates to profitability. When you stratify the profitability picture of companies and you compare that against the universe, the companies that are generating the higher profitability picture are the ones that outperform over time. We also, on our fixed income portfolios, believe that you can actively manage fixed income to generate value over market returns. Again, it's not about betting significantly on duration. It is about broadly diversified across a yield curve, but looking for opportunities in terms of pricing around term spreads and pricing around credit spreads, which is something that we do as part of our overall investment process. So our approach is a multi-factor model. First of all, we believe that these factors I just covered, investing in small and mid-sized companies, investing in companies that generate high profitability. We also really believe strongly in tailoring the portfolio around the client, working with the client around what they're trying to achieve, defining what those return expectations are, and then making sure we manage to that. It's not about hitting the ball out of the park. It's really about a consistent approach to generating what the family needs to require over time. We have access to the very best managers globally that share our philosophy and the factors that I've just described. We don't manufacture any products at Delisle. Back to our core belief about finding the best products at the lowest possible fee, we believe the best way to do that is to access the entire marketplace and find the building blocks and the products that work for us. And that's how ultimately we're able to tailor solutions for every client. So in summary, we do utilize low-cost ETFs for our asset allocation exposure. We utilize F-class funds with a firm called Dimensional Advisors. Dimensional Advisors is a very interesting firm that we've spent a fair bit of time with. They have over $1 trillion in AUM. They've been running since 1971, and they share our view about how to outperform over time with these 3 factors. In fact, 5 Nobel Prize winners are members of Dimensional. They're the pioneers in index funds. The founder created index funds in the US. And so this is really index funds to the next level with active manage. Finally, fees. We focus on the best possible products at the lowest possible fee. Consistently applying this discipline is how we believe so strongly we will add value over time. This is a back test proving out over the last 40 years those three factors and how they've performed relative to the market. So when you look here, you can see size, you can see profitability, and you can see the value versus growth. And as you can see, consistently, these factors have outperformed the market over time. You can also see this in terms of an annual composition. So when you look at each of these factors, as you're going to see, not every year, but most years, you're going to end up with outperformance. And the factors combined together is how you set yourself up for that consistency and outperformance. So in conclusion, our process is proven. It's a very data-driven, scientific approach to portfolio management.